The government and the Fed are printing trillions and trillions of dollars to fund the relief effort for this 2020 crisis, but have you ever wondered what happens if the government prints too much money? What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. In late 2019, the Fed secretly went out and printed $160 billion in a quiet QE or quack economics. I mean quantitative easing. Now in 2020, the Fed has the printing machine running on full speed. When the bond market started tanking, the Federal Reserve came out and they said that they would buy up to $700 billion worth of bonds to keep investors afloat. Then a few days later, that number was changed to an infinite number of bonds. When banks started running out of money, the Federal Reserve came back out and they said that they would give banks up to $1 trillion a day. That way they don't run out of cash. And the government passed a multi-trillion-dollar stimulus package to help fund bailouts and stimulus checks for Americans. Thing is, money doesn't grow on trees. Well, I guess in this example it does. But you need to understand the cost of printing all this cash, which is what I'm going to be talking about today. So make sure you watch this video until the end, because in the end of this video, I'm going to be showing you what happens if we print too much money. But before we get into that, hit that thumbs up button below, because if you don't, then YouTube doesn't show our video to anybody else. Subscribe to the Minority Mindset YouTube channel. That way you don't miss our new financial education videos every single week. And hit that little notification bell too. The government has racked up a pretty hefty bill in the first quarter of 2020 with bailouts, loans, stimulus checks, and grants. But how do they expect to pay it back? I mean, the government doesn't just have $1 trillion laying around. If they did, we wouldn't have record-breaking national debt. Well, the government is kind of like a lot of people. When they spend money they don't have, they put it on their credit card. Or a lot of credit cards. I wonder if that's where people get their spending habits from. The government isn't a for-profit entity. They get their money to pay their politicians and do everything else that they do from you and me, taxpayers, through our tax dollars. But the government doesn't generate enough tax dollars to pay their bills as it is. In 2019, the government spent almost $1 trillion more than what they generated, and now in 2020, the government has their regular expenses. They're gonna have less tax dollars coming in because people are earning less money, and now they have these huge new stimulus bills on top of that. In simple terms, that means the government is maxing out whatever credit cards they have. The first credit card that the government might try to use is their travel credit card, because it comes with perks like free meetings with foreign diplomats. Before this whole 2020 crisis started, the United States government owed something around $6.4 trillion to foreign countries, the biggest being Japan and China. But the whole world is going through a recession right now, so chances are that foreign countries don't have a ton of extra cash laying around just to give to the United States, so this credit card might be maxed out for right now. But that's okay. The government has a wallet full of credit cards, and the next credit card they might try to pull out is their cash back credit card. This one comes with perks like very low APR. You, right there, you have the opportunity to lend money to the United States government through something called a treasury bond. A bond is a loan. A treasury bond is a loan you make to the government, and James Bond is a really cool guy. You can call me Bond. Treasury bond. In theory, treasury bonds are supposed to be one of the safest investments out there because these bonds or loans are backed by the United States government, and we all hope and pray that the United States government isn't going to go into bankruptcy. But this low risk for investors comes with very low returns. That means the government doesn't have to pay you much in interest. Now couple that with the fact that many investors have lost faith in the United States economy, at least for the short term, and you have bond rates that are very low. And for the first time in history, we have people talking about and actually concerned about negative treasury bond rates. A negative treasury bond yield means instead of you getting paid to lend money to the government, you would have to pay interest to the government for lending them money. That would be very, very bad news, and I'll save that topic for a later video, so if you haven't subscribed yet, make sure you do that. So chances are the government's gonna max out this credit card too, but luckily, in the back of the government's wallet is their platinum card, the one with the $500 annual fee and no spending limit. The government can call up their best friend, the Federal Reserve Bank, and ask the Fed to loan them however many trillions of dollars they want. Now, to add another layer of complexity to this puzzle, the Federal Reserve Bank isn't actually a bank. Like, you and I can't go there to deposit money. It's not a reserve, meaning they don't have a huge cash pile of reserves sitting there, and they're not federal. They are a private entity. It even says that on their website. So if the Federal Reserve Bank or the Fed doesn't have cash reserves sitting there, how do they have the cash to loan money to the government? With the help of a printing machine. So the government picks up the phone and they call up the Fed and they say, "Hey Fed, can you loan us $5 trillion? And then the Fed will pick up their other line and they'll say, "Hey, Treasury Department, let's go to the printing machine." So then the Fed and the Treasury Department walk over to the printing machine, get the ink ready. Then they type in how much money they want. Boop, 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 boop. $5 trillion. The Fed prints this money and then they loan this money to the government, and now the government has the cash to do whatever they want. But all this printing money has a cost, and it leaves you with the bill, or the credit card statement. When you go to the mall and you shop with your platinum credit card, everyone's gonna think you're cool because you're spending all this money. Whoa, did you just buy all that from the Gucci store? But if you spend more than what you have at the Gucci store, you're gonna be left making payments to your credit card company plus interest. That's what's happening here, and you are going to be the one left with the bill. Remember, the government gets their money to pay their bills from you and me, taxpayers with tax dollars. That means more of our tax dollars are going to be going towards paying off debt instead of giving us services that we'd like to see. That also makes it more likely for our tax bill to go up in the future. And the second cost you have to pay is a hidden tax. I gave this example before and I really like it, and I can't come up with anything better, so I'm gonna give it to you again. When a crisis happens and people start hoarding toilet paper, now all of a sudden stores don't have any toilet paper left, and toilet paper becomes very, very valuable because the supply of toilet paper is very low. Hey, you want some of this? I got the goods. But during good times, everybody has toilet paper. Toilet paper is abundant, and so the value of toilet paper is low because, well, everybody has toilet paper. It's the same with your cash. As more and more cash is printed, the value of each dollar you have saved and each dollar you earn goes down, which makes the price of everything around you, your rent, your groceries, your medical bills, go up. This is what inflation is. It's a hidden tax because you don't even see it happening. It's a gradual change. Slowly, everything around you becomes more expensive and you are becoming poorer each and every day unless your money is growing with or faster than inflation. That's one of the reasons why the rich keep getting richer and the poor keep getting poorer. The rich understand this and they put their money in places that will grow with inflation. The poor don't. Now, before I go into what happens if we print too much money, let me give you a quick and easy tip to stop this hidden tax from hurting you more than it needs to. Move at least some of your savings to an online bank like our sponsor CIT Bank, because you can get a much better interest rate on your savings, and I got the link for you in the description below. CIT Bank is an online bank, which means they have less overhead and expenses than traditional banks do, which means they have more money that they can pay you with interest. It's free to open up a savings builder account. There are no monthly maintenance fees, and your savings can earn you a whole lot more. Plus, your savings are safe because CIT Bank is FDIC insured. I mean, they're a regular bank. The only difference is that they're online, which means they can pay you higher interest on your savings. So if you want to learn more and see how much more you can earn on your savings, conditions apply, and I got the link to where you can do that in the description below. Minority Mindset is a partner with CIT Bank, so if you use them, we will get compensated, but there's no additional cost to you. I mean, it's free to open a savings builder account. So if you want to learn more and see how much you can earn on your savings, I got the link to where you can do that in the description below. So there has to be a tipping point, right? I mean, if the Fed and the government can print as much money as they want, how come they don't just make everybody a millionaire? Well, there's a couple reasons for that. If the United States government gave everybody in the country $1 million, you'll feel rich for a day or two, but then you'll realize that the $1 million you got was essentially worthless because everybody's wealth grew by the exact same amount, so you're in the same place as you were before. Plus, we risk hyperinflation. Our paper dollars aren't backed by gold or silver or anything tangible. The only reason why this $100 has value is because the government says that this $100 has value. I mean, it costs 12 cents to print a $100 bill. If the Fed and the government print too much money, then we risk our currency becoming essentially worthless. That's why every investor and economist gets really worried when they hear about the Fed printing huge sums of money. This concept of printing too much money is known as hyperinflation, and we've seen it happen before. It happened after World War I in modern-day Germany, which was then known as the Weimar Republic. In 1914, 4.2 German marks, which was their currency at the time, was equivalent to $1 US. Then, after 9 years of constant printing money, it became 4.2 trillion German marks to $1 US because of this hyperinflation. Their currency became worthless. That's why people were literally walking around with wheelbarrows full of cash to buy just a loaf of bread. Now, I know the 1900s and World War I was a long time ago, but this hyperinflation happened in Venezuela in 2018 and 2019 as well. Venezuela was printing so much money that they hit the tipping point, and they weren't seeing the 2% inflation that we are used to. They saw something like 1,000,000% inflation in 2018, and then something like 10,000,000% inflation in 2019. The currency that everybody had been working for and saving their whole lives became worthless. To put some numbers on it, a loaf of bread that cost you $5 would cost you $500,000 after 10,000,000% inflation in 1 year. And that's exactly what happened in Venezuela. This hyperinflation is the worst case scenario when it comes to the economy. But as some reassurance, the United States dollar runs on faith. And lots of people have faith in the US dollar. I mean, it's known as the world's currency, which makes it less likely. That doesn't mean it's impossible. I mean, anything is possible, but it's less likely. That's why a smart financial planner will always plan for the best, but prepare for the worst. You don't want to just go out and get rid of all your cash and have no savings and then go and dig yourself into a bunker and never come out. It's not practical, and it's not the best financial advice. You need to have savings to protect you from emergencies. I mean, this 2020 crisis showed us again the importance of having savings, because businesses didn't have the savings to protect them, and people didn't have the savings to protect them either. This crisis showed us the importance of also having cash on hand. That way you can buy investments when they go on sale. Kind of like what we're saying now. And you should always own some tangible assets like gold or real estate. That way you always have something to fall back on no matter what happens. Plus, this is why it is so important for you to stay up to date on what's happening in the finance and business world. This way you can make smart decisions with your money. And if you're looking for an easy way to do that, well, we have the free Minority Mindset newsletter, where our team first breaks down the top finance and business news, and then we show you how this news affects your wallet. This way you can be smart with your money. Our newsletter is completely free, and you can join our newsletter by clicking the link up here or by clicking the link in the description below. Thank you for watching. If you enjoyed the video, share it with one friend. That way we can help spread the word. If you want to learn more about why most banks pay you nothing, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.